I shall now briefly set out the rationale for these decisions. Since the last policy, CPI headline inflation moderated to 4.9% in October from 7.4% in July. The moderation was observed in all components of CPI, namely food, fuel and core, that is CPI excluding food and fuel. There has been broad-based easing in core inflation, which is indicative of successful disinflation through monetary policy actions. The near-term outlook, however, is masked by risks to food inflation, which might lead to an inflation uptick in November and possibly in December. This needs to be watched for second-round effects, if any. Domestic economic activity is holding up well as assessed in the previous MPC meetings and as reflected in the GDP growth for the second quarter of this year. Against this backdrop, the MPC decided to keep the policy repo rate unchanged at 6.5%, but remain highly alert and prepared to undertake appropriate policy actions as warranted. Monetary policy must continue to be actively disinflationary to ensure fuller transmission and anchoring of inflation expectations. The rate action so far is still working its way into the economy. Hence, the MPC decided to remain focused on withdrawal of accommodation to ensure that, as I have already stated, to ensure that inflation progressively aligns to the target while supporting growth. I would now like to provide an assessment of the growth and the inflation situation. First, let me focus on global growth in brief. The global economy continues to remain fragile. World trade is decelerating amidst global tide of protectionism. Despite significant restoration of global supply chains, factors like elevated debt levels, lingering geopolitical hostilities, and extreme weather conditions aggravate the risks to global growth and inflation outlook. Easing of inflation in advanced economies has led to expectations of an early end to the monetary policy tightening cycle, shoring up market sentiments. Sovereign bond yields are softening as markets are not factoring in any further rate hikes. Coming to domestic growth, economic activity in India exhibited buoyancy in the second quarter of this year, aided by strong domestic demand. GDP growth, as you would know, posted a robust growth of 7.6% in the second quarter of this year, that is 2023-24, driven largely by investment and government consumption. Turning to the third quarter, two-thirds of Rabi sowing has been completed despite late harvest of Kharif crops in some states. Manufacturing sector gained strength with easing input cost pressures and pickup in demand conditions. 8 core industries recorded healthy growth in October and continued their high growth since June this year. The Purchasing Managers Index, that is the PMI for manufacturing, rose in November. The services sector buoyancy has remained intact as reflected in the high frequency indicators which the Reserve Bank monitors. GST collections at rupees 1.68 lakh crore in November 2023 were also buoyant. Services PMI displayed healthy expansion in November. In my statement, there is a lot of data available which I have put in the footnote, so those of you who are interested can have a look at the footnotes. The entire data in support of whatever I am saying is available in the footnotes. On the demand side, households' consumption is supported by durable urban demand and gradual turnaround in rural demand as reflected in sales of fast-moving consumer goods, that is FMCG, and other indicators. Festival-related demand is also spurring household discretionary consumption in capex. This is also in steel consumption, cement production, and imports of capital goods. Capacity utilization, in fact, continues to period. Investment in fixed assets by listed sector companies also registered healthy growth in the first half of 23-24, primarily driven by key industries such as petroleum, steel, chemicals, and cement. The total flow of resources to the commercial sector from banks and other sources at rupees 17.6 lakh crore during the current financial year so far is significant that of last year, which was at rupees 14.5 lakh crore. Despite weaknesses in external demand, both goods and services exports returned to positive territory during the month of October this year. Looking ahead, private consumption should gain support from gradual improvement in rural demand, strengthening of manufacturing activity, and continued buoyancy in services. The healthy twin balance sheets of banks and corporates, high capacity utilization, continuing business optimism, and government's thrust on infrastructure spending should propel private sector capex. The drag from external demand is also expected to moderate with a turnaround in merchandise and services exports. The protracted geopolitical turmoil, volatility in global financial markets, and growing geoeconomic fragmentations, however, pose risks to the outlook. Now, taking all these factors into consideration, real GDP growth for the current year, that is 2023-24, is projected at 7%. I repeat, real GDP growth is projected at 7% for the current year, with the third quarter at 5% and fourth quarter at 6%. Real GDP for we have provided the figures for the first three quarters of next year. So growth 425 is projected at 6.6%, for Q2 at 6.5%, and Q3 at 6.4%. The risks are evenly balanced. I would now like to turn to inflation. Food inflation, which was in double digits in July, has since then moderated to 6.2% in October, with correction in vegetable prices. Fuel inflation slipped into deflation since September, primarily reflecting the sharp fall in LPG prices in end August. The disinflation gathered momentum during September-October and in 2020 due to the combined effect of policy rate increases, reduction in across core goods and services. Going ahead, an outlook would be considerably influenced by uncertain factors. High-frequency food price indicators point to an increase in prices of vegetables, which may push CPI inflation higher in the near term. The ongoing Rabi sowing progress for key crops like wheat, spices, and pulses needs to be closely monitored. Elevated global sugar prices is also a matter of concern. On the positive side, global commodity prices, particularly agricultural commodities, have softened except rice. For highly import-dependent food items like edible oils, international prices continue to remain soft. Domestic milk prices have stabilized. Proactive supply-side interventions by government are also containing domestic food price pressures. It has softened considerably, though it may remain volatile. Taking into account these factors and the assumption of normal CPI inflation is projected at 5.4% for for the current year, that is 2023-24, with the third quarter at 5.6% and the fourth quarter at 5.2%. CPI inflation, and here again we are giving for the first 3 quarters of next year. CPI inflation for the Q1 24-25 is projected at 5.2%, Q2 at 4%, and Q3 at 4.7%. The risks are evenly balanced. Now,